and I create generational wealth through minimal savings. Good, easy way to start in a way. If you don't have a lot of funds and you want to try and make a quick
But also
income, as well as
contributing
also
the capital, and that capital is used to obviously fund the project. Family trust would be holding units in the unit trust.
Hi Minna, how are you today, mate?
I'm good, Ols. It's a pleasure to have you with us. As you know, Ols, I'm Mina from Pinnacle Accounting and Advisory, and you are from?
Capital expansion.
Fantastic. What does capital expansion do, and what do you do?
I'm a strategy-driven investment specialist, and I create generational wealth through minimal savings.
Yep. So what does that mean? So you help people, yep. So you look at overall what their savings are, right?
Yep.
And what their growth plans are. And then you help them, I guess, grow
I,
their
yep.
wealth through property. Yep. Talk us through that.
Yes. So I have a look at what their savings are. If they've got good moderate savings, we can start making some good money straight away. So straight away, we have to structure ourselves to be able to support this income without handing it all to the tax man. And then we also have to structure our savings in a way, our lending in a way that can support us and give us the best outcome and get the highest amount of property and lends through our structure of our strategy, and then
Yeah.
we look to the future about what do you actually want to get out of this. You want financial freedom in 12 years, and a couple of properties in self-managed super, good retirement secured. So how we're going to do this, and we'll work backwards with strategies through well-structured taxation and lending that gets us to a point where we start turning from aggressive into our collective of passive income. So
Yep.
it's all a
Beautiful.
bit of a
So what kind of activities? I think you mentioned before off screen that you do things such as subdivision. Can you talk us through that and various other ways to invest in property?
Yep. Okay. Yeah. So subdivision's always a good, easy way to start in a way. If you don't have a lot of funds and you want to try and make a quick income, as well as also hold some assets. So you can either just find good land priced areas where you see lots of subdivisions coming up and developers really want that land. So you can just buy a good property and just subdivide it, or even target one that needs a little bit of work and sell the subdivision off to create instant wealth, a couple of hundred K or more, and then renovate that property that you've got to bring it up to a higher value. The other way I target as well is that they're in high growth areas. So you can see that, there's a very low day on market. The price growth is about to start going. We've got population pumping into the area because of things like infrastructure, like the Westgate or the tunnels or the hospitals or some infrastructure that's driving this population growth. So and it's a good way just to get started. And in saying that, you make a couple of $100,000 in a year on a subdivision, and how's that going to affect you if you are doing it as a person versus a structure like a company or a trust?
Yeah, I think that's a good question. I think at the end of the day, you can hold investments in different structures. One of the most flexible ones is a family trust, depending on if you're going to take on the project yourself or if you are going to take the project on with other people, right? So, for example, you might have a family trust if you're just doing it by yourself. You might have a unit trust, and those units are held by separate family trusts, just as an example, right? And so each of these family trusts are buying units in the unit trust, but they're also contributing the capital, and that capital is used to obviously fund the project. You can also get bank loans and so on and so forth. So there's a difference between if you want to go at it yourself or if you want to go at it with other people.
Right. Yeah. Okay. And so if you're going to work together with other people, would use a unit trust, is that right? And so we're going to use a unit trust and we're going to have
Yeah.
several people come in with their family trusts that are inside this unit trust. Is that how that works?
Yeah. So each family trust would be holding units in the unit trust. That allows you to have the option and the flexibility of, well, do I hold on to these properties, right? If you hold on to the properties for 5 years or more, then when you come to sell them, you've got the capital gains tax discount. But
50%, is that correct?
50%, correct,
That's
correct.
right.
Okay, and then you
Yeah.
can flow that profit and those exemptions, right, that discount onto the family trust and then to the beneficiaries, be they individuals or other trusts. If you flow through to a company, the company doesn't get the 50% 12-month discount. So this
Right.
is where you've got to be careful. And sort of what you can do is you can put it in a company if you don't want to access these funds. And then later on, these funds can be accessed over many, many years, right? So you're just breaking down that profit and you're distributing it in a way where you're leveraging your lower marginal tax rates year on year.
That's right. I say, so let's quickly take one step back. And we're going to say we've bought a property and we've done a subdivision. When we sell that subdivision off, that only attracts 40% of the capital against it. Is that right? So we've bought the property at 100%. We've kept the house at the 60% point, and the land sells off at 40%. So we
How do you
get,
mean, sorry, when you say 60 and 40?
well, the investment cost us, say, $1 million,
Yes.
and we sold the subdivision off for 450,000. So now the primary part of the property that we bought was 60% in value with the house on it, and the land was 40%. So we sold off that. How does that work in
Yeah.
a structure?
So ideally, what you do is you would get a valuation, right,
Yep.
to determine what the value of each of those assets are.
Parts were.
Yeah.
Yep.
And then we determine roughly what the cost of those parcel of lands would be, right?
Yep.
There's obviously going to be a different cost because one of them is empty and the other one has a house on it. Okay.
Yep.
And then depending on what that is, then you determine what the capital gain would be. And then once you find out what the capital gain is, you can flow it to the different entities.
That's right. And so then let's have a look at that. If we're going to take that $400,000 and we're going to put it into a trust account, we're going to pay capital gains at the maximum.
You would pay capital gains at 50% of the profit, right? So say,
Gotcha.
give me a number of the profit. So say you
400K.
use it for 400K. What would be the cost of it? Say, what, 300? Say, just for argument's sake, 300, you've determined the cost base of that parcel of land is 300,000. So
That's right.
you've got 150,000 in profit, correct?
Yep. Correct.
If you're holding that in a trust, you've got the 50% discount.
Yep.
Okay?
Automatically.
Automatically, correct?
Yep.
So what does that bring us to? 75,000?
$75,000 taxable. Yep.
$75,000 taxable. So that 75,000 taxable gets pushed through, distributed. The trust doesn't get taxed. Okay? It
Yep.
gets pushed through the trust to the beneficiaries of the trust. Okay?
Which in this case, we're going to have it as the company, because the company is going to be the holder of all the assets all the way through, and it will distribute finances to the parties as it wishes. But
Well,
if everybody's got a good income, there's
it,
no use doing that to
it
increase
depends.
tax.
It depends what you want to do, right? If
Yep.
it makes sense to distribute it to the individuals, then we distribute it to the individuals. This is going to be
Yep.
based on what they want to do for tax purposes, but what they want to do also for commercial purposes. Do they need
Yep.
the funds to be reinvested? Do they need the funds for other personal reasons, right?
Well, so the main game here is to reinvest that money into another property.
Yeah.
As soon as
So,
we've got the money, we're going to go and get a loan against that money and against the assets that we've got, and we're going to go and get another loan. So how does that work?
yeah. So it depends, right? So again, you can pump it into the company, right?
Yep.
And then the company can loan it back to the next venture.
So
Okay.
when that happens, when we pump it to the company, does it automatically eliminate the capital gains and put it straight into your 30% tax
It
bracket?
eliminates, yeah, it eliminates the
That's
capital
exactly.
gain, right?
Yeah, that's right. Yep.
And depending on whether you're in a business of selling property or not, if we get the
That's right.
capital gains tax discount, then you're not in the business of selling property because you've held it for more than 5 years. Okay.
That's
So,
right. Yep.
yep. So it's going to flow through. It's going to get taxed at 30%, the whole 150,000, not 75,000, because you don't have
Yep.
that discount. Okay.
Yep. That's right. But if we move that money straight into the company, we now get that whole 50,000 taxed at the company rate of 30%.
You get
Less
the
its deduction
150,000. You get the 150,000 taxed at 30%. Correct.
at 30%. That's
Correct.
correct.
Now, that 30% tax doesn't just vanish, it just sits there as a franking credit that can be used and pushed out and attached to future dividend payouts,
Yep.
which effectively means you get the benefit of the tax paid as if you paid that tax yourself.
That's exactly right.
Okay.
Uh,
Now, the only reason why you'd pump it to the company here is if the other people are already at a very, very high tax bracket and their tax bracket is potentially higher than the 30% company tax rate.
which generally a lot of clients that we're working with are. They're already on the 100K a year plus, so they're already in the higher bracket. So pushing any funds out to themselves is nearly pointless. We're here to make money, and you can push it to your children or something like that to give them some income that are on the lower bracket. But otherwise, if you're not using the family trust, this is a money-making exercise. So we label a company as that sort of style and run it through the company.
Yeah, look, you can definitely distribute to your kids, but your kids need to be over 18 years old, and
Yeah,
the kids
registered tax. Yeah,
need to have
tax.
the transfer actually made to them. Okay?
Yep. Yep.
Now, if your kids decide to gift you the money back, that's their option, but there can be no compulsion for them to do that. Okay? Because then you're walking into Section 100A territory,
Yep.
and the ATO would frown upon that, and they would also apply the anti-avoidance provisions.
So you'll be getting audited annually.
You potentially be getting audited, right? It can trigger an audit, not annually, but it can trigger potential ATO audit. So you need to do things for the right reasons, and
Yep.
it's not compulsion. It can't be seen that there is a scheme to just
And
completely, I guess, minimize tax. It can't just be completely tax driven.
and to abuse the system. But I also see that I'm completely against it because, especially when you're trying to make money as a company, if you don't have a taxable income because you've pushed all your money out, the bank's not going to lend you any money because you've got no money. So you've got all your profits are being utilized out. Your company's not making any taxable income. So in the start of the growth, like anything, you want to have high taxable incomes, which means you pay a lot of tax. The best way to do it, in my eyes, you manage this better for the clients, obviously, but I suggest pushing it all straight into the company and paying your 30% tax. But how do we minimize that in a way that we can utilize the taxman's money? So can we defer this and then make payment plans or something like that to hold on to their money and utilize it for another period? How do we go about that?
Yep. So, first and foremost, whether it's in a company or in a personal name, that depends on the person's long-term goals. So this is where they work closely with the accountant, a financial advisor, say someone who is also in the finance space, or like someone who provides commercial loans or residential loans, and they speak with someone like you, Alls, right, who provides them advice on the journey. What steps do you need to make to get this development?
What
steps do you need to, correct?
Yep.
What steps do you need to take to be able to subdivide, to be able to renovate, right?
Yep, that's right. Yep.
And then depending on what they want to do, then we need to find out what entity needs to potentially receive that distribution, right?
That's right.
Because
Yep.
ultimately that's the entity is going to be taking out a loan. So there's various things that we need to take into consideration. Obviously, the individual's long-term goals and what they want to achieve.
Yep.
So it's not a straight
No, that's
yes,
right.
put in a company or put it in a trust. Each scenario is different depending on what the person wants to do.
And that's where I was pushing this whole conversation is every time you take another step forward, you need to readjust your strategy to suit. We are moving down the path, but the structure is going to change, continuously evolve, and so is the strategy and how we're going to do that. So originally we want to make a high taxable income. So how do we do that? We don't declare at tax time June, we defer it to May, and then we put it into a payment plan for 24 months. And
Yes,
we
yes, we can
utilize
do that.
the
Yes,
tax man's money to make ourselves wealth.
yes,
So in that time, we could have done another whole subdivision, made some money off of that. We put some of that profits into an offset account. That is, if we're doing it in a smart way, interest only offsets. So we're minimizing our outgoings, and that's just reducing the repayments of those loans. And that's the tax man's money. And he can chip away at that every 24 times to get all of his money back over 24 months. And
yep,
we might do a couple of plans of that. But then once we start going into a point where we're getting a couple of duplexes or something that's a high return, low cost, long hold that we're going to keep for life, that's going to be part of our positive cash flow, well, then we're going to try and start turning the tables. And when we start turning those tables, how do we alter all of this? How do we make this work better in the way of tax? Like, what's within that strategy, I'm going to start going this way and start turning this into, interest and instead of just interest only. How's that going to affect taxes? And where's that go with liabilities for you?
yeah, that's a good question. In terms of managing the cash flow aspects and paying the ATO, the tax man will ask you for interest, right? Because you haven't paid him, so he's going to ask you for interest, okay? But ultimately, the gains that you're getting from the property investment will far outweigh the interest that you're going to pay, right? It's just depending on what's going on. And again, you got to do the numbers here, right?
Yeah,
We're
that's
not
right.
just
Yep.
pulling things out of thin air. We are ensuring that we have a strategy and we've done the numbers. It makes sense, okay?
Yep.
In terms of switching from a interest only to principal and interest, the way that affects the tax aspect is you get less deductions if you don't do interest only,
That's right.
okay? So what a lot of people do is they do interest
And a
only.
higher cost.
Yeah,
And
so
a higher cost monthly.
correct. So,
So,
so a lot of people, what they do is they might buy a property, they will have it as interest only for 5 to potentially 10 years, and then they might decide, let's sell the property, right? When they sell the property, the capital appreciation of the property, when they come to sell it, pays for the majority of the principal that they originally drew out, the principal
yep.
loan, right? And then they just keep cycling that. It just depends on what the person wants to do, right?
Yep.
But ultimately, within that 5 to 10 year period, maybe you would have purchased another few properties, right? And these properties are now generating income for you. So you can use that income to start paying back the principal. It just depends on the properties that you're buying.
Yep.
Depends on your strategy. Again, the most flexible way to hold property is potentially a family trust. You can also hold property in a self-managed superannuation fund, but you'd need to wait a long time, depending on your age, to be able to access that.
So that is a final end goal security game plan. And how do we use that as a key benefit in tax? Like if we start looking at it from the company point of view, and let's say the person's already making 150,000 a year, so they're well into the top end of the bracket. Can we utilize some of this company money and start paying the 30,000 a year benefit or more into our super from the company to reduce taxes from the company
Yeah.
as
So
well
the
as
way, yep. So the way that would happen is the company might pay these individuals a dividend,
yep,
and then the individuals would put money into super and then claim a superannuation deduction.
so salary sacrificing from the company's payments.
Yep.
So
So
you
not
just pay,
salary sacrificing. So
or
they're not an employee of the
yeah,
company, right?
yeah,
But effectively, what they're doing is they're making a personal superannuation contribution, which they can choose to be deductible.
yeah, which is the payment that they've taken from the company to reduce the company's taxes. But like I said at the start, we can still do that, but we're trying to maximize our taxable income. But we can start playing that game down the line a bit
Yes.
stronger and
So
stronger.
as not to confuse the viewers, right?
Yep,
it doesn't reduce the company income. Okay, the company still pays 30% depending on what it is that it's doing. If it's not a business activity, it generally pays 30%. If it is a business activity, then it's 25%. Okay,
Yeah, but that's
what?
of the profit, is that right?
Yes,
So
correct.
if this 30,000 was paid out pre-profit, it's a cost to the company to pay that individual.
No,
No,
like I
that's a
said, I don't want
deduction.
to get, I
That's a,
don't want to get into,
you're
yeah,
not
I
using it
don't
as a
want to get the
payment. Yep.
technicalities of it. Okay,
Yep.
let's just keep
Okay.
it nice and straightforward.
Yeah, yeah, yeah.
Okay,
Okay. As a
ultimately,
deduction. Yep.
there's no deduction. The
I
company,
mean,
we're not getting the deduction. What will happen is, and again, I don't want to get into the detail of it because we might lose some people. Okay, this
yep.
is where they speak with the accountant, right? They can speak to us, and then we look at exactly what's happening with the company, what dividends can be pushed out to the individual, and what deductions the individual can claim in their own name, right? So effectively, the individual would receive a dividend which would increase their personal taxable
Income.
income. But
Yep.
then they would put money into superannuation if that is relevant, right? Which would reduce their taxable income, right? So it's the individual that pays the the deduction. It's the
The
individual
deduction.
who claims the deduction, right? Lowering their taxable income after they've received that dividend. But that dividend also has potentially franking credits, which they could receive as a
Later on.
refund,
Yep.
as a
Yep.
refund from the ATO. So again, this stuff can be
It's getting
very, very
technical.
complex.
You're starting to get complex. Yeah,
Very,
that's
very
right. Yeah.
complex. Okay, and it
But
can easily confuse people. This is where, like I mentioned, you need to speak to an accountant. You need to work closely to find
yep.
out what franking credits are available in a company and how to manage those things.
And I think you really need a whole team. You need the taxation to sort out tax. The taxation guy has to work with the finance. The finance works together with tax to about where we're going with the strategy, and the person who's obviously doing it is working with how they can manage their finances with the finance, with the tax, and with how they're projecting where they're going. So it's a big team
Correct.
event.
Correct.
Um, from a lot of angles.
Correct.
Um, and so,
Mate, what
uh,
I want to ask you a question in terms
yep,
of rental yield, right? What's better,
yep,
residential or commercial, and what are the pros and cons of each one of those?
right, okay. Well, commercial is by far an average better, average of, low of 8 or 9, 10, 12, 15 on a really good investment.
Mm-hmm.
The average of a residential is about 4.5. If you're getting 5 or 5.5, you're doing really good. Um, And the difference there is that if you're doing residential, you are paying all the outgoings. You've got the water bill, you got your rates, you got your insurance, you got your um, landlord insurance, you've got any other maintenance and stuff that you need to do. Whereas in residential they pay all outgoings. They may not have to do all the maintenance, and you may still have a bill of somewhat insurance, but they'll cover the bulk of that. They'll be paying all the rates, the water, all the outgoings, and that's structured um, inside the lease agreement.
And what are some of the factors that indicate whether you'll be getting a higher rent yield or not?
Well, the industry you work in, and obviously the cost of the premises that you got in the first place.
Yep.
So,
But is there things associated with demand also?
oh yeah, of course, that's right. Yeah, so like in a high population, high growth, high demand area, we'll pick somewhere in Melbourne like Tarneet and all the surrounding suburbs like there. We know that the government's pumping, 15,000 or 10 at least thousand people a year into that area, and that's why they're building thousands of houses each year. The growth in property is not going to be there. The rental yield is going to be fairly good in property there, but there's not much growth in the properties. But the joy of it is that there's that many people there. Commercial is booming. So if you can get in and buy a commercial property and have something that's really well supported, like say a childcare centre that's supported by the government as well, with government support, and all the people that are moving there, they're all having kids. Everybody needs to have their kids somewhere when they go to work. So those sort of industries just grow leaps and bounds. But to have a nice big property for somebody to bring a childcare centre company into, you're talking a several lots of millions. So how could we get around that if you only got a couple of million to put into this, and we're talking a 10, $15 million facility?
Hmm.
What can we do there from your point of view to be able to get a benefit?
In terms of having the cash flow to buy a property.
Yeah, to be able to actually get in there in the first place, to
Yeah,
have
so
something like this.
yeah, so definitely look at something like a unit trust, right? Where
Yep,
again you're pooling your funds with other people who are interested in the same development, and then you could obviously build that building, and you might rent that building out to the actual business. So it will
yep,
be a different entity that's holding the property and a different entity that's trading.
yep,
Okay, that's in terms of
yep.
that. Um, what I want to ask you is, in terms of uh, commercial commercial property, and even just property in general, how often or what percentage does it grow year on year? I'm hearing, my understanding is anywhere between 8 to 10%, and property generally doubles in value every 10 years. What are your thoughts on that?
That's so true. Sometimes it's in 5 years, you're doubling your property, and sometimes it's 25 years. Have a look at some of these areas, in high population, the high growth corridors. We're looking at 3%. On a good year, 5% growth. So you're talking 20 years to double that property. And once again, we'll pick on Tarneit and places like that. Some of them get a little bit of a jump up, but they're not, they pan out very quick, and even places like Wirrabee that have been facing this for a decade have not seen much growth for that whole time because they've been in high growth areas because of population, and there's just that many houses getting built. So targeting areas that have got high government, high infrastructure, high industrial growth before it's finished, one not just in planning, but when the government started to say build a $2.1 billion hospital, every house in that area is going to get a boom. With every kilometre you are closer, the higher your price will go up over the next 5 years once it's started. But also, while it's getting built, there's a lot of workers that are building that property, that hospital. And while they're building that, there's also all the other industries that are around there. So people need places to rent. Your prices just go up dramatically in those areas, and stay stable because we've got infrastructure that supported it, like, freeways and highways and availability to town, and major services like hospitals and schools. So targeting those sort of areas is a key way to get wealth, not following the leader and going, oh, I heard there was great growth over here. Well, that's try and find target areas that are getting major infrastructure spends, and try and buy in while the markets have dipped. So, and get in beforehand. So,
Yeah, absolutely,
okay.
mate. That's great. Do you have any region recommendations, area recommendations for us where you're seeing quite a bit of growth happening at the moment? Good capital
Um,
growth.
Yep, yeah, definitely. And I can see where there's lots of growth happening. Like, I mean, there's a lot of infrastructure happening in both sides of Brisbane, Sunshine Coast, Logan. Those places have gotten a lot of growth. There'll be a little bit left, but
Mm,
I mean, they've got a lot of growth in the
yeah.
last 5 years.
Mm,
A lot of those places have doubled or more in 5 years.
mm.
Um, you want to target areas that haven't got that yet. So where's that infrastructure spend going now? Well, I can look at a couple of places in Sydney, where there's a $2.1 billion hospital and
Reach
a
out to Oz.
$900 million
Reach
hospital,
out to Oz.
and
Yeah.
pick those pockets. $100 million school. Let's go find those areas and buy a piece of property there. It's going to get the growth.
Yeah.
They're building railways, they're building infrastructure. That's where you're going to go.
Mate, thank you very much for this session. I really appreciate
No,
it.
it's the same.
And
It's been
I
great
look
chatting.
forward to the next one. So stay
Yep.
tuned, guys. Make sure you're hitting that like, the subscribe, or whatever button it is to be
Yep.
notified of future ones. Thank you. Thank you, everyone.
Share and follow.
That's
Cheers.
it.
Cheers, man.
Oz
Awesome.
Middleton, Pinnacle Accounting and Advisory. Oh, got tongue tied there. Cheers, mate. Catch you. Thank you. See you on the next one.
See you guys.